Hi there. You get a dividend yield around 10% a year over the next 10 years. Are you pleased with this return from this company, Starwood Property Trust? If the answer is yes, then you might want to take a look at this company. As you can see, this is a mortgage REIT. They provide financing, loans to people to buy a house. And as you can see, the market cap is about 6.2 billion, price to earnings around 17, and the dividend yield is over 10%, 10.3%. If you look at the stock price over the last 11 years, for instance from 2016 to today, the stock price was flat, just an increase of 6%, but the dividend yield, if you look here at their history from 2015, has been stable, $1.92, 2015 to 2025. So if you like this return, you might want to take advantage. Now, another question you should ask is if this dividend is sustainable. Because if you buy right now, and if they cut the dividend, that will be quite bad. You will have a decline like this, as it happened during that pandemic. By the way, this was a great opportunity for investors to buy this mortgage REIT and have an increase in the stock price over 182% plus a dividend yield of 10% a year. So a quite nice return. Now, to understand this REIT, mortgage REIT, be careful because there are two different types of REITs, mortgage REITs and normal REITs. The difference between them is that, let me show you here, a mortgage REIT, as I said, makes money from the interest they earn on their loans, plus other income, like changing the fair value of their investments, swapping their loans, and so on. But the most important revenue is the interest they get on their loans. While a REIT, a normal REIT, makes money from rent. They take their rent and that's the revenue. And of course you subtract the expenses and the final earnings. So that's the difference between a mortgage REIT and a normal REIT. Now, to understand if Starwood can pay this dividend in the future, and maybe they can increase it, because over the next 10 years they haven't increased the dividend, you have to look at their income statement, which is the most important thing, especially if you can understand it. But I will help you, quite easy. So, you look at their earnings, how much money they made. You can better see here for the last 5 years. You can see that the revenue was, in 2020, 673 million and net income over 341 million. Here again, 400 million, 871 million, 349 million, and again 359 million. So, look at their profit margins, they are over 100%, for instance in 2022. And how is that possible? To make more in net income than the revenue. Well, that's quite easy in their case, because as I said, they earn money from their interest on their loans plus other income, which consists in changes in the fair value of their investments. So, or gains on their investments. For instance, they sell a loan, they report a profit, and that's included in their final net income. Again, for their changes in the fair value of their investments. If the value of their investments gets higher, they report profit, and they report that at the end in their net income. And that's why you see their net income higher than the revenue. You can think of this business more like a financial REIT, financial company. Because they don't have to take care of buildings or other plants, other operations. No, they have to take care of their balance sheet, the loans they have, and what they earn on those loans. So, let's look at the revenue first. Revenue 2024 1.9 billion, right? They report this in thousands. 1.9 billion. The interest 1.6 billion. Now, you also have to ask, what's the interest expense? It's 1.3 billion. And you also add the other costs with the management, fees, bonuses, and you see the total cost and expenses 1.9 billion. Look at total revenue 1.946, 1.982, and you see their expenses are higher than their total revenue from loans and other services and rental income. You can see here. So how come they are able to report the profit when their total costs and expenses are higher than their total revenue? Well, this mortgage REIT makes money. Their final earnings come from other income. And if you look at this other income, you can see some changes in the fair value of their loans and other investments. And these add up to their final earnings, plus income from affordable housing fund investments and gains on their investments. When they sell an investment, for instance a loan, they report a gain or derivative financial instruments. And that's why you see this net income, final net income. And you have to ask yourself, is this final net income is enough to pay the dividend? This dividend of 10%. Well, let's check it. Let's look only on their final earnings, net income, attributable to Starwood Property Trust here, 359 million. By the way, these are not the real earnings, but let's consider these earnings, right? 359 million. Final earnings for 2024. Now let's check how much they paid in dividends for 2024. Payments of dividends here, 619 million. And you see an increase from 2022 to 2024. 591 million, 601 million, and 619 million. So how come they were able to pay 619 million, but their net earnings, their final earnings, were about 380 million? How come? In fact, 359 million, sorry. How come they're able to pay 600 million dividends, but their final earnings were about 359 million? Well, you also have to look that on their balance sheet. They can easily make some money. Take money from cash. They have some cash, 377 million restricted cash. And also those loans held for investment and for sale. And you can see here loans held for sale, 2.5 million. So if they sell a portion of their loans, they can pay that dividend easily. But be aware that the income doesn't come from interest they earn on their loans, because those are covered by their expenses. Their income for the dividends come from other investments. Changes in the fair value, of course, these you have to ignore because those are not real earnings, but the income they earn on their investments and gains, especially gains on their sales, what they sell. So they sell some loans to pay the dividend. And now you have to ask yourself if this is sustainable in the long term. And let me show you something here on Morningstar. From 2015, right, to 2024 today, right? You see here dividend per share, $1.92, stable over the last 11 years, you can see here. And then the yield, dividend yield, 9.3%, which has increased to 7%, decreased 7%, then increased 10%, and so on. Depends on the stock price. And then you see here the total yield and some buybacks that they've made in some years. Just a little. And then you see here the payout ratio. What does it mean, payout ratio? Okay, it doesn't say. Payout ratio means the earnings, the percentage of the earnings they pay in dividends. And as you can see, over the last, more than 10 years, the payout ratio was about 100%, 121, 128, 126, 45, 107 in 2019, 165, 70 in 2020, and 179 in 2023. And the current 174%, which is the highest payout ratio compared to the history of this company. Now, this means that when you have the payout ratio higher than 100%, they use more than they make in earnings to pay the dividend. And this in the long term is not sustainable. Of course, over the last years, you can see that they've succeeded to do that. But here is the thing, there is another problem. And first of all, as I said, they are able to pay more than 100% because they can sell their loans, make some gains, change the fair value, and report some earnings and make some money to pay their dividend. They can do that easily, as long as it works. When it stops, then the dividend may be reduced. I don't think that will happen soon, but everything depends, especially mortgage REITs are quite sensitive to the interest rates. You can see now that they are quite high. If they get lower, and it's likely to get lower, this REIT, Starwood, their operations will get better. Because they have a lower finance, take loans at the low interest rates, and offer that money to other people at a higher interest rate. So if rates go down and stay stable, you don't have ups and downs, then this company, Starwood, will improve. You'll be able to report higher earnings in the future. Now, here is the thing with their dividend. You see here the number of shares for Starwood. Over the last years, from 2016 to today, it has increased from 230 million to 321 million. But how come the dividend has been about the same? $1.92. You better see here. While the number of shares have increased. Well, this company also increased the dividend. You can see here payments of dividends. 2022, 591 million. 2024, 619 million. So you see an increase in their dividend. And that's why, pay close attention to this, payout ratio got higher. As they continue to increase the number of shares, they also have to increase the dividend, even if the dividend per share is $1.92. As they have more shares, for instance, if they issue one more share, they have to add $1.92. If they add two shares, another $1. And that's why they have to increase the total amount. But be aware that the earnings, total earnings, over the last 3 years have decreased from 1 billion to 380 million. Of course, this 1 billion was because of their gain on here, income from affordable housing fund investments, when they reported over 700 million. So there is a lot of stuff. Don't get scared. But be aware that the more they issue, the more shares they issue, the more they have to pay in dividends, the total amount, even if the dividend per share stays stable. But you see this payout ratio, which gets higher and higher, and this is a problem. If it reaches more than 128% and stay around this level, 180, 200, that will be a problem because this company can cut the dividend. So this is the risk. This is the risk. It may never happen, especially if interest rates go down, but you have to be aware because this company, as you've seen, is stable. The dividend has been around 10% over the last 10 years. And if you want to invest in this company, you have to know what you can get. Because if you have a reduction in the dividend to 5%, you have a decline like this. And you don't want to lose your money. You want to make more money. So be aware. Don't go all in on this company. But if you like it, take a small size. Depends on your risk. Now, if you put a gun to my head and ask me what price would I pay for this stock? Then this question is available for members. If you want to know the answer, then you can join my membership. So that's it for this video, and if you have other questions, please let me know in the comments.